Welcome back to the monthly market commentary. I'm Brad Gotto, founder and CEO of Fiat Wealth Management. Here with me, as always, is Mr. Tim Holland. I go like this. I don't know if to everybody else you're over this way, but on my screen you are. The Chief Investment Officer of Town Square, Orion. Tim, thanks for being here with us, as always.
Yeah, good to see you, Brad. Belated Merry Christmas and an early Happy New Year.
Yeah, we're in that kind of like goofy week between Christmas and New Year. This whole season from Thanksgiving to Christmas is just kind of tough.
Yeah.
I've always thought that either Thanksgiving needs to be earlier or Christmas needs to be later. Like,
Interesting.
we should get two breaks, not like cramming them all in. Because every time you get together with your family on Christmas, you're like, I just saw you. I literally just saw you, and we're doing it'd be great if it was busted up a little bit, but that's just me being picky. Merry Christmas and a Happy New Year to you as well.
Thank you. No, and where I struggle, Brad, I just hit you with a belated Merry Christmas. You know, Christmas is over, but I still think I should say Merry Christmas to people until like almost New Year's. And then you know, which I probably irritate some people. I don't know. I get a little, this is a tricky week for me. For sure.
Well, then you get to the first of the year and it's like, do you take the Christmas tree down? Because it was so much work to put up, and the lights in the house, and like in Minnesota, ain't nobody getting on the roofs right now. So the lights stay up until like March or April.
Yeah, then next thing you know, it's April and you still have your Christmas. And I'm in Pennsylvania, so I don't even have the weather excuse. But every once in a while, my wife will be like, I think it's time. It's Memorial Day. We got to get the lights down.
The new thing is permanent Christmas lights.
Really?
They now, will install. They're much smaller, like LEDs, so you can't really see them.
Yeah.
Anyway, we don't. This is a monthly market commentary, not a Christmas spectacular. But it is December 29th as we record this. The end of the year is upon us. And so instead of our typical kind of 1 month in review, what happened the previous month and what's coming up to pay attention to in the coming month, we're going to do an annual review, just kind of a review of 2025 and kind of what 2025 brought us. And then with that in mind, some thoughts coming into 2026. And so, Tim, let's start with kind of this look back. Again, not on a month basis, but on an annual basis. Interesting year, to say the least.
Yeah.
And so before I've got some headlines I want to read to you that are coming out of some recent financial articles that I've looked up. But before I say that, I just want to say this. Like, isn't it interesting that if you, me, our clients, the average investor out there had to just close their eyes this year, had their eyes open on January 1st, shut them, and then open them today. And I was able to tell them, look, if you were invested in the three major indices, the NASDAQ, the Dow, or the S&P, at least in the equities markets, you'd have done somewhere between 13 and 22%. I think everybody would have been really happy.
Really happy.
I'll sure take that. And even on the debt side, even on the bond side, if you were just in bond markets, 6 to 7%. Again, I think everybody would have been happy. Now, nobody does that. And there was a lot of pain, fear, and consternation this year. Some of these headlines from the Financial Times, actually just as of today, it says U.S. stocks were eclipsed by the rest of the world in 2025. We'll talk about that. This is from December 23rd from Reuters. Major central banks deliver biggest easing push in over a decade. Financial Times, the day after Christmas, global deal making hits 4.5 trillion, the second best year on record. AP News, S&P 500 closes another record, beating its high set earlier this month. Market Watch, as of an hour ago, the hot AI trade faces a 1980s style trap. And these risks, says the bull market. December 2026, a very positive person from the Business Insider says the S&P 500 faces negative returns in 2026. Just all kinds of stuff. And then you stack on top of that, I couldn't find a good headline for it in prep for this, but the tariff deal. I mean, there's a million headlines about tariffs, but there's a lot of really interesting things this year. And so that is where I want to start, is really good returns. Just on the whole, snap a chalk line. It's been a great year. In spite of a lot of the news. And so I guess let's start there before I get into like some specifics like tariffs, trade wars, interest rates, things like that. On the whole, what's your overall thought process on kind of where we ended the year relative to thoughts coming into the year?
Yeah, and you haven't used Snap the chalk line in a while. I remember you used that during one of our first, and we talked about construction days. And yeah, my chalk line was never straight. I never mastered it. No, I think you're right. It's one of those fall asleep on January 1st, wake up December 29th. Wow, look at the year we've had. Must have been a whole lot of nothing but good news. There was
Yeah.
obviously a lot of volatility, and I think there are four things that I think either weighed on the market or pushed the market along, depending on how the four things developed, right? And for me, the big four would be the Federal Reserve, which came into the year after cutting rates and deciding that they couldn't cut rates anymore. And so there goes that ongoing easing that folks are looking for. There were real concerns around earnings, especially as inflation proved to be a bit stickier than people thought, and you had the uncertainty around tariffs. AI, there were concerns we were in a bubble. Obviously, that was something that kind of manifested itself a little bit more later in the year. And then you had trade, which was a huge question mark. And I think all four of those things, for me, in no particular order, were the four most important things for the market, good and bad. And I think what happened was where we landed, or as we're finishing up the year, all four of those things are much more in the positive column than the negative. So trade went from being a big question mark, a big negative around Liberation Day, to, okay, tariff rates are higher, but they're not nearly as bad as we thought they would be, and a bunch of big deals got done. Earnings came in 4 quarters in a row, low double digits, so much better than expected. There are still some concerns on AI valuation, but the businesses and the companies that are participating in that build out have continued to report really strong operating results. And then around the Fed, after not doing anything for most of the year, cut 3 times into the last cut being the December meeting. So those were the big four, and at different points in the year, they were the helping or hurting the market. I think ultimately what happened, those four things all really landed on the right side of the page. And that's why, to your point, high quality fixed incomes got you 6 or 7, and the big 3 U.S. indices have gotten you, well into the teens returns as we get ready to say goodbye to the year.
That's a lot.
That's a lot.
And our monthly market commentary is one of the things we spend a ton of time on, other than interest rates, which we're going to talk about, is the whole tariff deal. And so here we stand, end of the year, in spite of everything that we just got done talking about, really good overall equity returns, really good fixed income returns, in spite of tariffs, in spite of kind of the whipsaw of what was going on in the markets. In fact, I just looked it up. The low on the S&P this year was on April 8th, and it was at 4,982. The high was December 24th. Intraday was 6,932. If you're a math whiz, that's about a 40% swing.
Yeah.
Peak to trough this year. That's crazy.
Yeah.
4982 to 6932. And the 4982 in April, this was kind of peak tariff problems, trade problems. And so in spite of all of that, kind of talk to us about where we've landed and maybe peek us into 2026, because I wouldn't say, and I'm curious if you agree, it's not over. I don't think that there's no more uncertainty when it comes to trade policy or the tariffs. And so talk to us a little bit about because again, 40% intra-year swing an index is pretty crazy.
Yeah, pretty remarkable. So you're right. We're not done solving for trade, and obviously much of what comes next will depend on the Trump administration and how they approach negotiations with China, Mexico, and Canada. The USMCA, sort of NAFTA 2.0, is up for renegotiation anyway next year, and U.S.-China trade has not been sought for. We had some really scary headlines earlier in the year, and then both countries decided to just punt. So we still have some work to do. And then the Supreme Court is going to weigh in on whether or not what the administration has already done with trade and tariffs is constitutional or not. So it's gotten really quiet from a headline point of view the last month or two, which has helped the market and sentiment. But we do have some big things to solve for next year. I'm working off the assumption, and not to sound cynical, the economy just printed a 4.3% Q3 GDP number. Markets are at all-time highs. Gasoline prices have come in, though people are still upset about the absolute level of prices, especially in the grocery store. If you're the Trump administration and you're getting to go into a year where you're going to have to try and hold on to very slim majorities in the House and the Senate, I've got to believe they're going to find a way to solve for China, Mexico, and Canada next year. I just think you want the economy cooking with gasoline. And if there's one issue that seems to really resonate today with the average American voter, it's this question of affordability. Right or wrong, the mayor-elect in New York City rode that issue to his rather easy win. And even in some of the off-cycle gubernatorial races, both taken by the Democrats in New Jersey and Virginia, that was the winning issue as well. So anything that adds to inflation is going to be a big no-no. If you don't solve for trade or tariffs, you could see a spike in inflation. So a lot of work still to be done, but I've got to believe they're going to get it done next year. Really, for no other reason, they want to try and clear the decks ahead of next November in the midterm elections.
Yeah, really good point. With the political races and what we saw in the swings this year, it just, as we continue to talk about this, Tim, I just think about, like, at the beginning of the year, had you given some of these headlines to people at the beginning of the year, and then asked, do you want to stay in the markets? They'd have been like, no, I don't think the markets can overcome some of the headwinds or kind of headlines, if you will, that are coming this year. Whether it was the trade stuff, we haven't even talked about the fact that our government was shut down for 43 days.
That's right.
In part of this year, amongst the interest rate, issue in the Fed not cutting as aggressively as a lot of people had hoped for and wanted, although they did cut. And in spite of all that, here we are with double-digit returns in every major indice from an equities perspective anyway. So the other thing I do want to touch on, because I find it interesting, and as a financial planner that's building plans to stand the test of time and not trying to build wealth in concentration, but protect it through diversification with the vast majority of our families, I feel like a little bit like proud or like told you so a little bit. And so I don't want to like rub it in, but I do want to at least bring up or mention the fact, this headline that I was talking about earlier, and that is the Financial Times, U.S. stocks eclipsed by rest of the world in 2025.
Yeah.
Let's talk a little bit about that, because it feels to me, Tim, like it's been like pulling teeth to get our clients to stay diversified. And what I mean by that is specifically outside the U.S., because for years now, U.S. markets have outpaced our non-U.S. market brethren or international markets. And so kind of that call to stay diversified was starting to fall on deaf ears. And here we sit. And so talk to me a little bit about what happened this year relative to domestic versus international equities markets.
Yeah. So to your point, if you go back to the S&P, which is up high teens year to date, which is fantastic. If you look overseas, developed markets, the Germanys and the Japans collectively are up high 20s, 28, 29%. And the same thing for emerging markets, right? The Mexicos and the Brazils, if you look at those countries collectively. So 1,000 points of outperformance. And if memory serves, it's the best year for the rest of the world relative to the U.S. in about 20 years. So you have to go a ways back. And we're big believers in diversification and diversified portfolios. And you're right, it's been hard to make the case for the rest of the world. And I think what finally happened this year was those markets have been cheap for a while. And you saw a couple things. One, you saw the dollar start to come in as the Fed started cutting rates. Again, a weaker dollar tends to be good for overseas markets. But you also saw, and this is something we've talked a lot about over the last year or so, some meaningful policy changes, especially in Western Europe, around infrastructure spending, defense spending, energy independence because of the Russian invasion of Ukraine. That's really starting to hopefully light a fire under some really important economies, including Germany and France, which have struggled for years with probably, not to pick a fight, maybe too much bureaucracy, not enough investment, and not enough incentives for public capital to meet private capital. So all that coming together, you've seen these remarkable returns. What's interesting is the rest of the world is still a bit cheaper than the U.S., and next year's earnings growth should be at least in line with the S&P 500. So it's been a great year. It feels like it's more than just a one and done kind of phenomenon for us that the rest of the world should continue to catch a bid into 2026. And it's just nice to see our clients benefit from owning those more diversified portfolios as opposed to something a bit more concentrated.
It's one of those deals where if you're patient enough to stick with it, or had somebody in your ear like us in your trying to keep you in international markets, it was nice to see it pay off.
For sure.
And I agree with you. I still think when you look at valuations, people, you look a lot of these really amazing American companies, stalwarts in the S&P. But then you look at the valuation, you're like, gosh, it just seems like they're overvalued. And I'm not saying they are necessarily. Then you go to the rest of the world, and a lot of it seems the opposite, where it's like, gosh, it seems like it's kind of cheap relative to what it should be. And so I agree with you. I still think there's some great opportunity out there. Now, that doesn't necessarily mean performance, as we're talking about, because with all these possible negative headlines, that doesn't necessarily correlate to negative markets. We've had a really strong year in equities markets in spite of some of these massive headwinds. I'm just still laughing about the fact that we're adding to this a 43-day government shutdown. Because in all the headlines I read, that wasn't even
forgot about it.
Yeah. It just kind of it was just a month ago that they just opened this thing back up, and here we sit, and it's not even news anymore. Crazy how that happens. The last thing I want to touch on before we get to 2026 is just the AI bubble. This has kind of come in late in the year. This hasn't been a conversation we've been talking about in our monthly market commentaries all year long, but I feel like once the headlines started to come out, it became the talking point. I got more questions from clients, or we as a firm got more questions from clients on this very thing than I think on any one point, probably since COVID. And it came in kind of hot and heavy, this whole idea of an AI bubble. So can you address that just a little bit?
So artificial intelligence, building these large language models, the backbone of AI requires a ton of software, a ton of hardware, massive data centers, a lot of dedicated energy to run those data centers, so on and so forth. And with ChatGPT getting released 3 years ago, this fall, give or take, from OpenAI, that's kind of what got the whole trade going. And then to your point, when some of the public companies like NVIDIA hit $5 trillion in market capitalization, no company had ever done that before. And some of these massive investments were being announced both by public companies like Oracle and NVIDIA, and private companies like OpenAI and Anthropic, some of the big players in the private market. People started to think, well, this seems to feel a lot like and look a lot like the dot-com bubble in the late 90s. Some of these valuations are a little silly. Some of these companies are investing in each other, and those investments are a little opaque. We wonder if this is ever going to pay off. And so the markets really started to wobble October, November around that because of that narrative taking hold. We've spent a lot of time looking at it. There's not obviously a ton of information on the private companies like OpenAI and Anthropic. There's obviously a ton on the public companies. We don't know if we're in a bubble. If we are in a bubble, not to punt on it, we think it's early as opposed to later. The companies that are involved from a public market point of view are very well capitalized, very profitable. They have multiple business lines. This isn't just a dot-com kind of play to go back to the late 90s. And we do think AI is going to be transformative from an economic point of view. And I know it's something our company's all in on for sure. And so will some of this money that's being spent and invested get misspent, misallocated, as they say? I'm sure some of it will. But again, we don't think this is something akin to what we saw 25, 26 years ago when the internet really sort of came into sort of public view, and you saw some really silly business decisions being made then. So that's how we think about it. And a lot of those stocks, after stumbling, including NVIDIA and Oracle, have started to find their footing again as well. So that's our 2 cents for the time being.
Well, it's a great 2 cents. I mean, these days, 2 cents isn't worth a lot. We're not even making pennies.
Yeah, we're getting rid of the pennies.
You're just going to have to give 5 cents at a time at a minimum. No more. You can't even give 2 cents.
That's a good point.
One of the things that's super interesting to me about when people we always try to do this, right? We always try to relate current issues to something that's happened in the past, which isn't necessarily bad, but our brains, it's natural of our brains to do that. Like, how do I pathway this? You're trying to connect it to something that we know, which of course is something that happened yesterday. keep in mind during the .com that at one point in like 1990, I was just looking up some stats on this. 1999 alone, Tim, there were 370 technology-related IPOs.
Yeah.
Now, to put that into perspective, there's less than 4,000 stocks on the New York Stock Exchange.
Yeah.
370 IPOs in 1 year. That's more than 10% of the total exchange from a company's perspective, at least in today's number of companies. And that was just in the 1 year. And then you fast forward to 2004, post.com, 48% of the companies that went live during kind of that IPO craze were actually still in existence.
Yeah.
So over half of them failed.
Yeah.
So the difference here is the majority of companies that you're talking about weren't created because of AI. They're existing companies in the tech space that happen to be, lobbing onto, adding in this AI deal. And so it is different. It's very different. And I'm not saying that there isn't companies being created because of AI, but when you look at the bubble and where all the money is being spent and infrastructure is being created, it's in existing companies with massive balance sheets, largest companies in the world, really, from a valuation perspective. And so very well capitalized. It's just a different deal. And so, yes, there's always going to be similarities. And I'm not saying there isn't a bubble, but there's a ton of differences that are worth noting. To me, the .com thing was just nuts. You basically needed a social security number and to be able to fog a mirror to go public in 1999 and 2000. And a lot of these companies had multi-million-dollar valuations, billion-dollar valuations without ever having sold a product or made a dollar or anything, and that's just not what's going on right now.
That's a really good way to frame the trade or how the space is building itself out. And then to your point, usually if they're ringing a bell as a bubble is about to really pop, it's at the risk of sounding cynical, it's when a lot of folks are trying to cash out. So the insiders, the founders, the Wall Street folks, and there's this mad dash to go public, to sell shares to the public, to have a liquidity event. And to your point, that's just not happening right now. And again, the companies that are involved in the space, even the private ones where we do have information, have real businesses, real revenues, and obviously the public companies that are participating, the NVIDIAs and the Oracles of the world are, to your point, some of the largest, best capitalized companies in the world. So again, we would draw those distinctions and differences as well.
Yeah, great point. Let's look forward. 2026, I would say, we're still not completely certain what's going on with trade. So let's talk a little bit about that and tariffs. Let's talk a little bit about this inflation that I feel like it's that like lingering cold. Not to make light of it, and I say this with my tongue firmly planted in my cheek, so please don't take offense to this, but like there's COVID and then there's long COVID, right? Like these long-term effects that seem to just kind of keep lingering on. I feel like that's kind of where we're at with this inflation deal. And then on top of that, we're still trying to get a footing or a hold on, like we had really good earnings coming into this year, and now that's, or we didn't expect it, but we did. Like coming into next year, it seems to be, it's in the headlines again as another concern. Although the concern wasn't brought about in 2025, we had really good earnings on the whole. It's in the headlines again to be worried about it in 2026. And so feel free to kind of bite off any of those as you see fit. But I guess what's your overall kind of thought coming into 2026 and what should we be paying attention to?
So I think trade,
maybe something that's not even in the headlines.
I think trade is still on the list for sure. U.S., China, got us off for that, and then Canada, Mexico. Those are the three biggest trading partners. So again, we've gotten some work done, but that's still important. The government's only funded fully through the end of January, so we could be looking at another government shutdown. Those tend to have not much of an impact on the markets, but you kind of move away from that uncertainty and it comes back. I think of the 12 appropriations bills that need to be passed and signed into law, only 3 have been. So you wouldn't have a full shutdown, but come the end of January, if they can't agree on a continuing resolution or a full funding of the government, we could be back to where we were, not that long ago. The Supreme Court will rule on the constitutionality of what Donald Trump has done with trade. And he's also trying to remove the president, Fed Governor Lisa Cook. So the Supreme Court will weigh in on that. And Jay Powell's term is up May, so we're going to get a new Fed chair, and we have the elections next year. So the policy headwinds that buttress the market from time to time tend not to have much of a meaningful impact. It does come down to earnings and interest rates, but I think between the elections, questions around trade, and questions around the Fed, the start to the year could be a little goofy until we get some clarity there. And then ultimately, it's going to come down to earnings, and can the S&P continue to deliver this kind of low double-digit, mid-teens growth rate? And if we can, that goes a long way to solving any sorts of problems around valuation or just price appreciation, where the markets are as we exit the year. So I think, you kind of go back to those four things we talked about: AI, trade, earnings, and the Fed. Those are going to be the four big things again, I think, in 2026. And we'll also probably get a little more clarity on how some of these big private market AI companies are doing. And that will either sort of help that trade along or get people a little anxious again. So I'm sure there's other stuff and stuff that's not in the headlines, but I think a lot of what mattered this year is going to be what matters next year. It's just going to be different players and different issues tied to those four topics, if that makes sense.
It does. I'm going to put you on the spot. I know you're a pretty optimistic guy, and that's one of the reasons I like you.
Yeah.
Are you a bull or a bear in 2026?
I'm a bull right now. I appreciate where markets are trading, what the valuations are here at home for sure. I think I'm a bull for a couple of reasons. One, things in motion tend to stay in motion. So the economy has navigated this very uncertain period really well.
Yep.
Earnings have done much better than expected, to your point. The other thing that's coming is, the One Big Beautiful Bill Act should really impact the economy in a meaningfully positive way in 26. So you're going to have a policy tailwind for sure. So, whether or not, I'm not a price target kind of guy, whether or not the S&P can give you 17 or 18% again, I don't know, but I do think there's a lot more the market has going for it right now than going against it. So but I still like being broadly diversified, especially today, given some of the returns we've seen in different markets. So I know that's kind of a belt and suspender, kind of milk toasty. I'm an optimist, but I'm also a coward. I'm much more optimistic than not. I just think there's more good than bad. Hitting the market right now. I really do.
The good news for you, Tim, is there's a place for optimists that also are cowards. It's in a broadly diversified portfolio. I love the sentiment. I've always said, and I will always say, that if you don't believe in the long-term viability of our free market system, you shouldn't be in the free markets anyway. Because it is a long game. It is an investment. There's a difference between investments and gambling. And while we do talk kind of month to month and now kind of a year in review, because it is worthwhile to have the conversation, what I hope those of you who are listening, especially if this isn't your first monthly market commentary, let's just say you've been following us for the last couple of years, I hope what you're realizing is the more you dig into this stuff and you get past headlines, you get past a clippy type article or a grabby type headline, is the more you study it, the more you realize you just don't know what you don't know. And it's just one of those things where, in order for us to have positive financial plans, positive portfolio returns, it is a long game. And we brought it up, you pointed it out, so I'm going to say it again. If you snap chalk line, the markets do really well over time. They just do. Now, this year, great year, double-digit returns. You look over the last 5 years, cumulative return, every major indice, again, NASDAQ, Dow, S&P, somewhere between 90 and about 110% total return in the last 5 years. So even if you're wrong, and next year ends up being a 20% pullback, your portfolio has returned to a mid-2024 value. Nobody's financial plan, I hope, is built on a doubling of your portfolio every 5 years. And if it is, you should probably redo your plan. So we're all kind of, I would say that the average portfolio out there over the last handful of years, Tim, is way ahead of pace, so to speak, and way ahead of expectations. And so I only say that to put into perspective that even if we're wrong, my optimism, your optimism, there's a pullback, something grabs a headline, strikes fear, and the markets pull back, whether it's fundamental or emotional, that we're still going to be okay.
Yeah.
There's still opportunities out there to make money, but it's also one of those deals where I hope you're right. I think fundamentally there's more data to support your opinion than the opposite. But I also just want to remind people that this is why we stay diversified.
Yeah.
And this is why sometimes you get to the end of the year and you look at your portfolio and you're like, gosh, you guys are sitting there talking about double-digit returns and everything. My portfolio cumulatively only did 7 or 8%. Yep, exactly. But it's also the portfolio that loses 4% when it's down 20. Because to your point, being a coward sometimes is a positive. You could make the argument that that's just I want to play the game. I just want to do it in ways that I can afford to do it financially and emotionally.
Yep.
And so just kind of another reminder coming into next year that planning is very, very important. And this year represented opportunities for us. Volatility in the markets always represents opportunity. Back in April, we were doing Roth conversions for families. When you look peak to trough, had that Roth conversion been done, I'm not saying we timed this perfectly, but those conversions that were being done in April, the valuation of the S&P then to now, like I said, is a 40% swing. That's a massive windfall from a tax perspective for families. So volatility always represents opportunity for us as well. So bottom line is, it was a very interesting year. And overall, in spite of all that negative and that we talked about, just a great year. And every year I do this, Tim, the longer I'm in this industry, the more I'm just fascinated by how emotions drive things in the short term. And then when you take that view and back it out and look at the forest and not the tree, how resilient our U.S. economy is.
Yeah, no, that's all really well said. It's been an interesting year for sure. It's been a great year. A lot to be grateful for, not to get on my soapbox, but this time of year in particular, it's always good, I think, to look back and count one's blessings. And not to speak for anyone who may be watching this, given the returns that most portfolios have done, celebrate it. I think, not to be bossy, appreciate it, because it has been a remarkable year for the markets, even with all the uncertainty. But you're right, Brad, sort of a couple gray hairs, couple market cycles, you start to appreciate the ebbs and the flows, the emotional impact that the market can sort of exhibit. And if you learn to put things in perspective and lean this way or that way at the right time, you can navigate it a lot more easily and usually make some pretty good decisions that accrue to your clients' benefit over time. But it certainly has been an interesting year. We'll see if 2026 is as exciting. I don't know if I could take. I mean, I wouldn't mind boring. Boring would be good. I'm a coward and I'm boring. So that's I'm looking for a boring year.
Tortoise and the hare, Tim.
There you go.
Tortoise. You still win the race. You still win the race. You just got to get all the way to the end of the book.
I run so slow, I go backwards. I mean, that's like, but yeah, that's me. I'm the tortoise. Slow and steady.
That makes it sound like you have all of your money in cash and inflation's running hot and you are literally just going backwards. I don't think that's true, Tim. I think you're not giving yourself enough credit.
I'm fully invested, high quality fixed income and a ton of equity exposure. I think all of us don't take enough risk. Even though I'm a risk averse kind of fella, most investors don't lean in enough, considering lifespans, longevity, incremental inflation, all the stuff and preach and plan for. We all, like, whatever your risk tolerance is, again, I'm being breachy, you probably take that and you kind of try and add 10% to it or so. If you've got 20 or 30 years, you kind of lean in because you know what the markets can do for you over time. But it can be hard emotionally, but that's how, that's where I'm going.
Always appreciate the time. It'll be very interesting getting back together with you early February and figuring out how the year had started and being able to review January. I'm just very curious because although in some respects January 1st means nothing as opposed to any other date, but because it is a calendar that we've created and we flip it to a new year, man, it changes people's thoughts and opinions on everything from the markets to their own personal health. And I'm one of those guys waiting until January 1st to start eating healthy. So we'll see what happens.
Now, look forward to talking to you in 2026 and really want to wish you and your lovely family a happy and healthy new year, Brad.
You as well, and to the listeners as well. Enjoy your new year. I don't know if you're going to get to see this before the new year, or so if it's past tense, I hope you enjoyed your new year. And I can't wait to continue to bring this content in 2026. Tim, it's been a great year. Thanks for spending the time with us in 2025, and always continue to be a great partner.
Thank you so much.
Thanks, listeners. Happy New Year, and we'll see you in 2026.